Hello and welcome to Your Money 2.0. I'm Justin Lally, a reverse mortgage specialist at Cambridge Credit Counseling Corporation. Over the next 20 years, more than 70 million baby boomers will retire. And if current surveys are accurate, a large percentage of these individuals will be woefully underprepared. According to reports from Reverse Mortgage magazine, only 38% of baby boomers will have saved enough to get them through retirement. Although that statistic is grim, a review of the overall retirement landscape is even more startling. Approximately 78 million Americans currently have no retirement savings plans whatsoever. Very soon, they're going to discover that Social Security alone won't allow most Americans to continue in the lifestyle they're living at the time they retire. A significant number of these people may need to rely on the equity in their home just to make ends meet. Some of you may be saying, that's what Social Security is for. Well, Social Security was never intended to be the sole source of income for retirees. It was created to provide retired persons with the resources to cover basic expenses. When it was established, the average life expectancy was just 65 years. However, the average lifespan in our country has increased by almost 30 years since the 1930s. Needless to say, this has compromised the effectiveness of the program. The average senior citizen now receives about $2,000 a month from Social Security. However, the average annual monthly expenses nationwide are closer to $3,000. That imbalance is a clear indication that we have to do much more to build appropriate retirement funds if we're going to make it. For those of you who are already retired or will be soon, there are financial tools available to help you if your retirement savings are lacking. A reverse mortgage enables homeowners who are 62 years or older to convert a portion of the equity in their homes to subsidize their retirement without having to sell the home, transfer title, or take on a new monthly mortgage payment. Just like the name suggests, a reverse mortgage is a regular mortgage in reverse. Instead of the homeowner making payments to the lender, they receive money from the lender. Reverse mortgage loan advances are not taxable and generally don't affect your Social Security or Medicare benefits. There are three types of reverse mortgages that homeowners can choose from, each with its own advantages and disadvantages to consider carefully. A single-purpose reverse mortgage is generally the least expensive option, but it's also the most restrictive. These mortgages are offered by state and local government agencies and nonprofit organizations. As their name indicates, this type of reverse mortgage can only be used for one purpose, which is stipulated by the lender. Homeowners can also apply for a home equity conversion mortgage, which you may have heard referred to as a HECM mortgage. These loans are backed by the U.S. Department of Housing and Urban Development, or HUD. Finally, proprietary reverse mortgages are private loans backed by the companies that develop them. The proceeds from both HECM and proprietary reverse mortgages can be put to a multitude of uses, including supplemental retirement income, home repairs, meeting healthcare needs, preventing foreclosure, and so on. Before applying for a HECM loan, and before you apply for some proprietary reverse mortgages as well, you must participate in a counseling session with a HUD-certified counselor. The counselor must review any additional options available to you, including any other home equity conversion options currently available. The counselor will also discuss the financial implications of entering into a reverse mortgage, including tax consequences, and the impact of a reverse mortgage on your estate after you die. Most counseling agencies charge around $125 for their services, but the fee can be paid from the loan proceeds. Just how much can a reverse mortgage add to your retirement portfolio? The amount you can borrow depends on your age, the current interest rate, and the appraised value of your home or FHA's mortgage limits for your area, whichever is less. Generally, the more valuable your home is, the older you are, and the lower the interest rate, the more you can borrow. As you might have guessed, there is a lot more to these unique loan products, and you have to do your homework before you commit to one. To learn more about reverse mortgages, please visit www.aarp.org/REVMORT, a website established by AARP's Reverse Mortgage Education Project, or contact your local HUD-certified housing counseling agency. Well, that's it for this edition. As always, we welcome your feedback and ask for your thoughts and suggestions by emailing us at yourmoney2@cambridgecredit.org. Thank you for watching. Until next time, I'm Justin Lally for Cambridge Credit Counseling.